Good morning, everyone. Am I audible? Good morning, everyone. Welcome to Officer 24/7. My name is Niharika Valia Bhatnagar, and I'm with you with the area of ABFM. And today is, as we know, it's the marathon day. I'm going to have a mini marathon today regarding the area of ABFM. So today I'm going to cover the module B further. But before I proceed further, please share this particular session among your peers. Along with this, if you like this particular session, then don't forget to like it as well. And if you haven't subscribed to our channel yet, then kindly go ahead and subscribe it. Right? Chaliye. So let's continue further. I hope the ABM exam went well for all of you. We received a lot of messages from the bankers who were giving the examination that it went good. So let's proceed further. Acha. Hey, this is the first question, everyone. It says that what does the which of the following is not an advantage of internal accruals? Which of the following is not an advantage of internal accruals, everyone? What do you mean by internal accruals? Internal accrual is that part of the money which is kept as savings in the business. Matlab, see, the organization earned 100 rupees. They are not giving the entire 100 rupees to their employees, to their shareholders. They say to the shareholders, we need a little money for our future as well, for the future of the business. So, can we give you only, say, 50% of it or 60% of it? The shareholder is going to ask, what are you going to do about the remaining 40%? They say this is what every Indians do. So that is what we will do as well. That is, internal accrual is a saving part of our profits earned for the future of the organization. So internal accruals can also be known as reserves and surplus. So when we talk about this, no cost for use or servicing is there, can be used for short-term purpose only, readily available or does not change ownership structure. What happens with this? Which of the following is not an advantage? This is a negative MCQ there, which is talking about no cost of using or services there. Technically, that's our savings, so we can say that. है ना? Then, when we talk about can be used for short term purpose only, our savings can never be limited to only short term or only long term. The savings that we are having is to meet the emergencies of an organization. So, when we talk about a normal emergency, it's never a short term or a long term one. So, it's always, in this case, the answer would be B. It can be used for short term purpose only. Rest in the other areas, na, there are two, three contradictory points as well. When they say no cost for use or servicing, in one part of the book they have stated this. In the other part, you will see that if we talk about cost, whatever cost to equity is, because equity shareholders have to be kept happy now. So whatever cost of equity is, same is the cost of the internal accruals as well, because this is a part of your equity, है ना? Then it is readily available. This is correct. Does not change the ownership structure. This is also correct. Only one contradictory part is there. In one part of the book, they say there is no cost, and then in the other part of the book, they say cost of internal accruals is the same of that of equity. So it can be used for short-term purpose only. Okay, here comes the next question, a question based upon reasoning and assertion, everyone. Internal accruals include profits retained by the company, such as general reserves. This is what internal accruals include. The depreciation is considered as a part of internal accruals as it increases the cash balance. Does it? The question says internal accrual include profit retained by the company such as general reserve. That is true. When we talk about, as we just talked about it in the beginning only, na, when I said what do you mean by internal accruals, this was the same definition that I gave. This is the part of the profit which we do not give to our shareholders. But what is a little more troublesome and confusing is depreciation is to be considered part of internal accruals as it increases the cash balance. See, in this case, one thing is absolutely sorted. Depreciation has nothing to do with internal accruals, right? In this case, the that is true that depreciation is a non-cash expense, but it doesn't make a difference regarding internal accruals. So both the assertion and reasoning are true. Reasoning is correct explanation. This is definitely wrong. Now we'll have to see which particular point is correct. Both assertion and reasoning are true, but reasoning is not the correct explanation. Assertion is true, reasoning is false. Both assertion and reasoning are false. This one is also not there. The correct answer is actually B. Both the assertion and reasoning are true, but reason is not the correct explanation of assertion. Okay. Then comes the preference shares are preferred over equity shares in terms of dividend and liquidation payment. Cumulative preference shares guarantee dividend payment even in the years with insufficient profits. Now, when we talk about preference shares, now preference shareholders are given preference because of one strong reason. That is, the preference shareholders buy the shares with this particular condition that whatever the case may be, they will always be paid before equity. So in this case, preference shares are preferred over equity in terms of dividend and liquidation. This is correct. The preference shareholders gets a preference over equity in these two areas itself. And then cumulative preference shares are the ones in which they accumulate dividend in case the company is not able to pay in a certain year. Then even in the years with insufficient profit. I've told you about the explanation of both the cases. Both assertion and reasoning are true. Reason is the correct explanation of assertion. Both assertion and reasoning are true, but reasoning is not the correct explanation. And assertion is true, reasoning is false. Both assertion and reasoning are false. What's the correct answer? What would be the correct answer, everyone? And if you like this particular session, please go ahead and share it as well. What would be the answer for this question? Preference shares are always preferred over equity. That's one of the basic conditions of preference shareholders. You know, when we talk about preference shares are always preferred, it's true, and they are above in terms of equity at the time of payment of dividend as well as at the time of liquidation of the company. Basically, now equity and preference are both the kids of the company. But preference share is the spoiled kid who says that whenever you are making any kind of payment to equity, pay me beforehand. They receive dividend. Preference share said that fine, you pay dividend to them, but give me before them. And then at the liquidation of the company, when preference shareholders said that even if the company is dying, pay me before them. So whatever is left or leftover would be theirs. So that's why I would say the equity shareholders are the residual holders of the company, right? And cumulative means in any specific year. For example, we have D1, D2, D3, three different years. The company paid the dividend of first year but couldn't pay the for the second year due to insufficient profit. In the third year, they will pay D2 plus D3. This is called cumulative preference shares. in terms of cumulative preference shares, you will find that in the organization they have this thing that if the company is not able to pay their money in one particular year, it will compensate and give it in the next year. So in this case, the correct answer is both assertion and reasoning are true, but reasoning is the correct explanation of assertion. Then everyone, chaliye. Now let's move on to the next point. What is not the reason for companies to raise preference shares? Source of funds for a very long period, high cost of raising funds, retention of control over management, or improvement in debt equity ratio, which is not a reason. See, if you look at this entire question now, these are advantages of or features of preference shares, and this is actually a disadvantage, right? So in this case, can I say that it is B, considering all three are basically the reasons why the organizations are taking preference shares. So that is B, that is high cost of raising funds. Next question, everyone. Okay, I hope it's visible now. Go ahead. Term loans are generally granted for a short term period ranging from 1 to 10 years, and term loans are primarily used for financing the establishment or expansion of the projects. The answer, everyone: term loans are granted for a short term period ranging from 1 to 10 years, or term loans are primarily used for financial expansion and of the projects. See, uh, in technical life, I would say the term loans are longer even. But normally, when business are taking loans, I would say that both the points are correct in context with our IIPF book. That is, the term loans are generally granted for a short to long term, and these are normally for the projects. The answer is A. Both assertion and reasoning are true, and reasoning is the correct explanation of A. How are loans typically repaid? In one bullet payment at the end of EMI, through equal monthly installments covering both interest and principal. Repayment is not required. This is definitely not true. Quarterly repayments for the entire loan. Technically, we have three different options in this case: 1, 2, and 3. Among, according to you, which one among the following is normally used? Bullet repayment is normally done by big organizations which are financially very, very strong. So, this is not something that you will find in a normal case. And even when we talk about us, we do not pay the loans quarterly. You know, what we do is we pay it monthly. So in this case, the correct answer is through the equal monthly installments covering both interest and principal. Next question, everyone. Which type of asset is generally used as security for the term loan? Collateral security, personal assets of the promoters, tangible assets purchased through the term loan, or all of the above? What would be the answer? Okay. Technically, though, basically, why do we give the securities? We give the securities that what if it says, what if the organization is unable to pay? If the organization is unable to pay, then what will they do? This particular security will be seized by the bank. You know? So in this case, what will happen? Is it the collateral securities? Collateral securities, yes, they are. Overall, na, the assets which are given as attached properties, they are basically collateral securities. What else are the name? Personal assets of the promoters. There is no limit to it. Ki we cannot add the personal assets of the promoters. Assets, tangible assets purchased through the term loans. Whatever you buy from the term loans is also covered under this. For example, people buy a car on car loan, and if they are unable to pay the car loan, what will happen? Then they will have to their cars are confiscated. So this is what is it about. The typical types of assets which are generally used in terms of security is actually all of the above. The answer is all of the above. Next question. This question is about working capital term loan. What do you mean by WCTL? When we talk about WCTL, na, it says in a business, there are certain loans which are required on or to meet their daily expenditure. This is not our irregular expenditure, but this is our regular expenditure that happens on every single that happens every single day in the business rather, because you need to run your business. Now, how do you run your business? You run your business through the working capital itself. So, how do we define the working capital? It is a type of normal term loan provided by the bank or financial institution, or WCTL is to address the temporary liquidity constraints in servicing the working capital loans. In this case, what is it about? Both assertion and reasoning are true. Both assertion and reasoning are true, but reasoning is not correct. Explanation or assertion is true, but reasoning is false, and both assertion and reasoning are false. WCTL is a normal loans which is given, that is true. First is definitely true. But WCTL is used to address temporary liquidity constraints in servicing working capital loans. Not really. WCTR is basically daily loans which are required to be paid off. So that is not something which is there in order to cover up the temporary liquidity. This is not their work. That is done by bridge financing. The liquidity, the temporary liquidity constraints can be removed through bridge financing. So in this case, the correct answer is going to be A is true, but the uh, reasoning is definitely false. Answer is assertion is true, but the reasoning is false. Here comes the next question. This question is regarding payback. Which one refers to the cash inflow under payback period? It's actually a question which is very much relevant in our examination. These kind of questions are typically asked these days. Thank you. This says that which one refers to the cash inflow under payback period. That is cash flow before depreciation and taxes, and this is very important even. I think module B and module C is all about calculation of the CFAT or cash flow from operations or FCFF and FCFE. You'll find all these terms being derived a lot in module B and module C. Almost every question has this. So in this case, what would be the answer? The cash flow before depreciation and taxes, cash flow before depreciation and taxes, or after, before, and before both, and one after. What would be the answer? What they say is CBIT, that is EBIT, earnings before interest and tax. They are normally looking forward towards that. But in this case, when we talk about EBIT is different, but we're talking about cash inflow under payback period. In this case, what do they have? They have whatever inflow we are making in the payback, whatever inflow is there, that is CFAT, that is cash flow after tax. One of the best ways is to learn these as small terms, just like the acronym that I've created. You can learn it by using the words CFAT or EBIT or FCFF and FCFE. In this case, it becomes easier to remember because longer sentences are hard to remember. So the answer, excuse me, the answer is the cash flow after depreciation and taxes. What they do is, once you get this inflow now, you tend to add back depreciation to find out your genuine amount of cash inflow and cash outflow. And then you can decide whether you want to go for that kind of decision making or not. Concept of present value is based on the principle of compounding, the principle of discounting, A and B, or none of the above. When we talk about the present value factor is basically because of only and only one thing, that is principle of discounting. Compounding is moving forward. Okay? So basically the compounding can be said to be moving forward and discounting means to come back. For example, your present value is basically principal 1 plus r raised to power n will give you your future value. है ना? After how many years we'll be receiving such money. This is the formula for calculation of the amount. And what if the question says, I don't know what are we going to invest today, but after this much amount of time, I will need a good money. So in this case, you will determine the compounding and then you will see after 10 years of investments, what are we getting? This particular thing being multiplied by 1 plus r raised to power n. Now go ahead and divide it. 1 plus r raised to power n. Now, what you can calculate is your future in terms of your present money. We're not living in the future, we are living in the present. So, it is based upon that part only. So, in this case, the correct answer would be the principle of discounting, everyone. Because when we talk about present to future, this is compounding. This is discounting. Done? Now comes the next question. The cost of capital from all the sources of funds is called. What is the name that we take up for cost of all funds? Specific cost or composite cost or implicit or simple average. This kind of question is normally asked. Which rate to follow? Weighted average cost of capital or the normal one? Because only that particular method should be used further. Is it specific cost, composite cost, implicit, or simple average? Which one is the answer? When we talk about the cost of capital from all the sources of the funds, it is going to be composite, also called the weighted average cost of capital. WACC is equal to your that is cost of debt multiplied by weight of debt. Let me write the exact formula itself. cost of debt, and weight of debt. And then we have cost of equity and weight of equity plus cost of preference multiplied by weight of preference. This is the formula for the entire portion of cost of capital, WACC method. The correct answer in this case is composite cost, also called the weighted average cost of capital. Done. Let's move on to the next question. The next question says, out of the following alternatives, methods of the project evaluation and selection used in capital budgeting, which one of the combinations is the code corresponds to discounted cash flow methods? International rate of return, payback period, profitability, or net present value. We have got these four methods. Look at the four methods again: IRR, payback, profitability, and NPV. What would be the answer, everyone? For discounting, which one is used? See, payback period is not, if it they would have written discounted payback period, only then we would have done the portion of calculations. In this case, it would not be the payback period because payback deals with absolute figures. It does not deal with the present value factor at all. The one which deals with present value is actually, the name of that method is discounted payback. Okay, so that is discounted payback, not payback. So all other methods actually use the portion of discounting the cash flows. So technically I can say the answer should be 2. All three are capable of going through the particular portion of the discounting methods, which is definitely more accurate even. In this case, the answer would be 1, 3 and 4. 1, 3 and 4 is B. Acha everyone, how's the preparation going on? Naveen sir, got your message? And yes, that is correct. The answer is B. This is again regarding EBIT. When the expected level of earning before interest and tax exceeds the indifference point of two alternative financial plans, equity financing and debt financing, then the use of debt financing world would be advantageous, or use of equity would be more advantageous, or the use of debt financing would reduce EPS, or the use of equity financing would keep them would keep the EPS constant. Earning per share is the total earnings of the organization, and from the earnings we actually create the from the earnings the organization is preparing their further businesses as well, na. So in this case, brutality or sorry, in this case I can say, when we talk about the area of indifference point, indifference means that no profit no loss. The use of debt financing would be more advantageous. The use of debt financing would be advantageous to increase the EPS. What would be the answer in this case, everyone? Debt financing is more advantageous, everyone, or equity? I believe both have their pros and cons. Equity is good when the market is going good and people should invest in more on equity. Then it's good. But equity, this means a lot of people have got a decision making power and you are not the sole proprietor anymore. You are not someone who would be dealing with all these resources alone. So technically now, in this case, the debt is more advantageous than equity. Answer is A. Okay, everyone, here comes a match the following up. Match the list of items of A with the B. Financial breakdown point, cost volume profit analysis, or internal rate of return, or net income approach. What would be the answer? The rate of discount at which the NPV is zero. Yes, sir, the paper level was very tough. They have increased that particular area. So, Naveen sir, if that goes well, then let's increase the pace. What would be the answer in this case, sir? When we talk about the financial break-even point is the point at which we are recovering all the cost. है ना? Cost volume profit is that particular situation where our volume is perfect, that our cost is minimum and the profit is maximum. Internal rate of return can be something which I can state is a situation where NPV equal to zero. Whatever I'm investing, I'm getting it back. This particular rate is called IRR. And net operating income approach talks about what is the amount of income that we are generating every single year, right? So in this case, what would be the answer? When we talk about the financial break-even point, rate of discount, acha, in this case, when IRR second is equal to third is equal to A, this is the first one. This brings the maximum clarity. Analysis to study relationship between fixed cost, variable cost, and sales pro cost and volume. This is the point. Cost of capital remains the same for different degrees of financial leverage. And the last is the minimum level of earning before interest and tax needed to satisfy all financial fixed assets. Organization has to cover its break even point. So in this case, the options which are available are these. But let's calculate it as if we are doing it in terms of the area of the question itself, because they can actually go ahead with these questions in that way. Na? So let's look at the question there. This is A, then cost of capital remains the same, net operating income approach gives B. The financial break even point is actually D. This is D. The first and the D part. Financial break even point, that means we are able to recover our cost, and cost volume profit is the relationship between all these three. So, can I say in this case the answer would be uh, that would be 3A and 3A. This is only one. Rest everything is different. So I think the answer would be this A. 3 is A, B is 4, C is 2, and D is 1. This is what we got. D is 1, then 3 is A, then CVP is again given there. So you can check it out. This is actually a question which was asked in a higher level examination as well. And they have now started taking a lot of questions from those higher level examinations because there is a lot of similarity in our paper with them. So this question is a little longer. So let's have a look at it. The following four factors have been identified as explaining the stock return and its sensitivity to each factor. The risk premium associated with each factor have been calculated. GDP is given as beta and RP. This is a question from our book itself, everyone. A very important questions to review. So please do this question very carefully. The question says GDP is given, inflation rate is given, gold prices are given, Sensex index is given, as well as they have given the risk-free rate of return. In this case, can you see there are more than one sensitivity analysis, sensitivity factor which they are considering? When you have multiple sensitivity factors, how do we consider them? When you have multiple sensitivity factors, how do we consider them? We can consider them using this particular method where I am going to take my risk-free rate of return, which is 3%, then add up all the factors, the GDP growth rate and its beta, zero point 0.6 into 4%, inflation rate and its beta, 0.8 and 2%, then 0.8, then we have minus 0.7. This means the beta is negative. If the world is changing, the beta says I am going in negative. Then plus the last one, 1.3 multiplied by 9%. In terms of arbitrage price model, they have multiple sensitivity tools in which they have risk-free rate plus whatever your beta is, and you have your risk premium, the extra premium that you are ready to pay just because you are taking the risk. Because obviously when you want reward, you have to bear more risk as well. So in this case, what is going to be the answer? It is going to be 3% plus 6 into 0.6 into 4%, 0.8 into 2%, 0.7 into 5%, and 1.3 into 9%. So in this case, the answer will come out to be, the answer is going to be 15.2. Difficult but an important question asked in the can be asked in the examination, as is created from the IIBF examples itself. This is one of the examples that they have given regarding arbitrage theory. Simple question. This can be asked in the form of a case study format as well, that they can give you what is the sensitivity factor in terms of the GDP only. GDP, then it is going to be 0.6 into 4%. How much is it going to be? 0.6 into 4%. 0.6 into 4 is 2.4. So can I say this is going to be 2.4? And the second is going to be 1.6. And this is going to be negative, minus 3.5. And the last is 1.3 into 9. It is going to be 11. So it is going to be, this is plus. Then we have 3 plus 11.7. Then we have plus 2.4 plus 1.6 but minus 3.5. So that gives us 15.2. You just have to multiply with the terms, everyone. This is an easier question, but you have to remember the formula. Next question. Indicate the cost of capital based on CAPM model. Similar model. The difference between arbitrage pricing and CAPM is the formula. That is CAPM is equal to risk-free rate of return plus beta. Then we have your RM minus RF. What do you mean by CAPM model? CAPM model says, what is that return that you will get even if you're taking not even a single point of risk? There must be something which is definitely going to be there. They said, yes, that is our risk-free rate of return. Then they said, then add up beta to it. What do you mean by beta, everyone? In terms of beta, can we say this is your beta is the sensitivity factor. If the market changes this much, how is it impacting us? This much, or the same as the market? Then this is our risk premium. Risk premium means the extra premium that we are getting because we are ready to take the risk. That is RM. The market rate is say 15% and the pakka amount is basically 3%. The short amount that we are receiving. So that means the remaining portion is purely the risk premium. Now, what would be the answer? In this case, they are given the risk-free rate of return is 9%, beta is 1.4, and the expected rate of return on equity. This is the return that you make from the market itself. This is going to be 1.6 minus 9%. Yes. What would be the answer, everyone? What's going to be the answer? It is going to be, acha, there's one mistake there. This is 16% now. This is 16%. This is multiplied. That is going to be 16 minus 9 multiplied by 1.4, giving us 9.8 plus 9. The answer is 18.8. Such kind of questions can be asked in the examination. They can also divide this question into a case study further. Considering it to be a case study, then what would happen? Being a case study, they can ask you what is the value of risk premium, number one. Then they can also ask you a case study. In this case study, they can divide it into 3-4 parts. One can be, what is the CAPM model? They can give you a question key, what is CAPM model formula? Second is, what is the risk premium? And the third can be the rate of return of equity. So in this case, this particular question can be divided into a case study of, you can say, 1 mark, and this can be of 2 mark and 1 mark. I believe this can go up to 4 to 5 marker question. Okay? That's how they play with the words there. Though in the last exam there were less numerical portions, but questions were asked from the numerical portion in a typical theoretical format. So you have to do the numerical part very carefully as well. Achha, next question. The reinvestment assumption in case of IRR techniques assumes that cash flow can be reinvested at the project IRR. Cash flows can be reinvested at the weighted cost of capital. Cash flows can be reinvested at the marginal cost of capital, or none of the above. When we talk about reinvestment assumption, reinvestment means, see, I received the money and I'm not taking it out of the business. Rather, I'm going to let it stay in the business itself. So in this case, what's going to be the answer? It's going to be A. The cash flows that can be reinvested at the project IRR. Reinvestment means the inflow that we are getting, we are not taking it out. We are putting it in the business again so that we can generate more and more funds. That is what we talk about. And this is there exclusively in the IRR. IRR is there in the capital investment decisions chapter. Okay? Done, everyone? Here comes the next question. Naveen sir, is it going fine now? Please confirm. Okay. Chali. Now let's move on to the next question. The next question says multiple IRR. This is also a situation. This is given in our book itself. I think this is from the book itself. The question, multiple IRR are obtained when the cash flows in the early stages of projected exceeds the cash flows during the later stages. This is a question from the IIBF book. This was there in the book itself. Cash flows reverse their sign during the period. Cash flows are uneven or none of the above. Multiple IRRs can come when we have inflows during the year as well as we have outflows. That means, yes, there are certain uh, correct correct form of inflow is there, that is plus, and there is a reverse, that is minus also there. That is, there the cash flows reverse their sign during the project. That means it can be plus, minus, minus, plus. These kind of situations leads to more than one IRR. Done? This is a question, and here comes the next question. How is the evaluation of the outcome done in decision tree analysis? This is there in terms of scenario analysis, decision tree, and many other things. Decision tree is basically a tree format. Tree format means, you and I were talking. I said the possibility of this thing is happening or not happening is this. If it will happen, it's a yes. If it will not, then it's a no. If it's a yes, then the following two situations will arise. If it's a no, this one will arise and that is a dead end. In this case, this situation will lead to a yes or a no, and this one will lead to only one thing. So in this case, when you are forming branches kind of thing, right, that is what we call it as tree, you know. These, because of these branches only, it was called decision tree analysis. When you take a decision, it has multiple impacts. Moving forward from the starting point, moving backward from the last branch, or focusing only on the branches with higher rewards, or eliminating all uncertainties. What would be the answer in this case? The answer would be B. Moving backward from the last branch. Basically, now this point, how is the evaluation of outcome done? When you are looking at the outcome, how do we come back to the outcome? If this was the specific outcome I was looking at, this was a yes, and this one would have led. This is my final outcome that I want to study. So from this outcome, I will study this node of all the yeses, and then I will reach to the original point from where I want to start. So technically the starting can be shown in this way. That is why it is called decision tree. And everyone, next question. What is the first step in the decision tree analysis? Evaluating the outcome, drawing the decision tree, identifying uncertainties, or discarding alternate course of action. What is the first step in decision tree analysis? Evaluating the outcome. This kind of question can always be asked. They'll give you some process and they will say ask the sequence of the same. And normally this is one of the areas where we have maximum problems. The answer is drawing the decision tree. When you are looking forward to the first step is we have to see how many yeses and nos that we have. If we have a yes and if we have a no, how many outcomes can come out maximum out of it. Okay. So in this case, the right answer is drawing the decision tree. Next question, everyone. Why is a shorter time to market considered beneficial in the risk market management? It allows for a comprehensive market study. It reduces the competition and meets markets expectations, or it provides more predictability in the market. It increases the average price for period for improved product models. Why is shorter time is there? To make considered beneficial in risk management. As such, shorter time period is considered uh, beneficial because you get the outcome at a very quick time. Matlab, I don't have to wait for a longer period to find na. So basically what happens is when we have shorter time to the market considered na, so in this case it allows the comprehensive market study, it reduces competition, meets the market expectation, provides more predictability, or it increases the average period for improved product model. I would say that most of the things are long term only, but when we talk about shorter, why is shorter time to market considered better? It is considered better because it reduces the competition and meets the market expectation. For example, in terms of tender, the one who's giving the fastest plus the lowest is something that we'll choose. Why? Because that particular thing will ensure that we are getting what we want. In risk management, what is emphasized when considering new products, technologies, or territories? Jumping into action without sufficient preparation, then testing the depth of the water with both feet. Is this really good? Normally, it's not. You cannot just put both the feet into the water just to find out the depth. It is very, very risky. The risk management, what is emphasized when considering new products, technologies, and territories? Jumping into action, testing the depth of the water, taking help of experts, and ensuring thorough preparation, or that is perfect execution without any homework. Is it a perfect execution without any homework cannot be done? One thing is sorted. What is emphasized in new products? Jumping into action without sufficient information. You enter into something without proper preparation, then you will definitely be failing. That is not something that we can look forward to. Then testing the depth of the water with both the feet is not a good option too. Then, but you take the help of the experts, who will help you, who will guide you to achieve that particular goal. So in this case, the answer is C. Taking the help from experts and ensuring thorough preparation. These kind of question can definitely be asked in the examination, and everybody would be like, "Ma'am, from where is it?" I haven't seen something like this in the question in the book itself, or maybe in the MCQs. These are prepared from the read between the lines only. Between the lines, there's a certain area, and then these kind of questions can definitely be created in your examination as well, because this is the same thing has happened with the JIB this year as well. Okay, so it's better that we open up ourselves towards learning more and more about the book. What does the cost benefit analysis help determine in risk management? The level of uncertainty in the market, the resources required for risk mitigation, the probability of uncontrollable risks, and relevance of forming a separate risk management department. What does the cost benefit analysis talks about? Cost benefit means what you're getting for the business. Is it really benefiting the organization or not? What does the cost benefit analysis help determine in risk management? The resources required in risk mitigation. That would be the answer. The answer is B. And everyone, chaliye, let's do another question as well. Why do sensitivity analysis aim to reveal about the project? The exact future cash flows, certainty of achieving the project cash flow, sensitivity of NPV or IRR to changes in key variables or project's impact on the market trends. What does the sensitivity analysis aim? Sensitivity tries to understand which particular things increase the price or decrease the price, or has a good impact or the bad impact on our organization. So in this case, we are going to find the various reasons and what are the impact of those mistakes, what is the benefit of those things. So in this case, the correct answer is going to be C. The sensitivity of NPV or IRR to changes in key variables. This would be the correct answer. Done, everyone? Let's look at the next question as well. I think we can continue it a bit more, and I think we can have a few more classes of these kind of things for module B further. It helps in understanding and managing the risks associated with key variables. It is helping you in business and understanding. Acha, this was there in the book itself. Na? If you look at the book, na, they have given you what if I change the initial investment? Then what will happen to your NPV? What if I change the cost of equity? What will happen to it? And then, other than the cost of equity, let's talk about other things. If the time tenure of the things are changed, if the residual amount what you are getting out of it is also changed, the cash flows are changed, these are key variables. As soon as any of these variable changes, your NP will automatically change, and when it is changed by any of these things, then what will happen in this case, it will show all the information, isn't it? So this is one of the key variables that is there. Okay, let's go for this. Would be the last question for the day. In the realm of risk management, particularly in contingency planning, contingency means if there's an emergency. Then, how does a detailed action plan contribute to facing and mitigating the risk? A detailed plan focuses on its risk only, risk avoidance, neglecting the need for mitigation strategies. The detailed action plan identifies possible events adversely which are working for the company and assigns the duties to manage those events, contributing to the effective risk mitigation. A detailed action plan is unnecessary as are unpredictable, cannot be planned in advance. A detailed action plan is primarily concerned with risk acceptance, overlooking the need for risk mitigation. That's why risk mitigation means we're going to reduce our losses or risks to the maximum limit, because having a lot of risk and all is going to be a very big problem for the organization. So, in this case, what's going to be the answer? Everybody, what's going to be the answer? The answer is a detailed action plan with possibly events adversely affecting the particular area. We are not going to look at the factors which are going to affect the business, but we are also going to mitigate the losses that can happen if we face that problem. A detailed action plan identifies possible event adversely affecting the working of a company and assigns the duties accordingly. Because if you know the risk, you can at least mitigate it. Elimination of the risk altogether is definitely not possible. Okay, next question. Then, acha, I'm still left with a good number of questions, so I'll just deal with one more and let's call it a day. And then we'll be considering it further then. What is the first step of conducting sensitivity analysis? NPV, then identifying factors impacting NPV or IRR, developing mathematical models, or analyzing the internal rate of return. The first step of this particular method, everyone. The first is basically to identify the factors impacting your NPV or IRR. In this case, B is correct. First of all, you literally have to look forward to all the key variables which are impacting your NPV and IRR. You will try to reduce it further because ultimately reduction is definitely required. The answer is B. Identifying factors impacting NPV or IRR. Okay? Chale. Then let's call it a day, everyone. But before we end our session, I hope you have reviewed our courses. Our revision batch is starting soon. Uh, so before we proceed further, here it is. This is our website, that is www.adda247.com, where you can go and you will find it on our JIB and CIB area. Go on to our JIB CIB area. This is where you will have to go on to the CIB November 2023, and you will find double validities going on our CIB Mahapack and Bank Mahapack. Bank Promotion Mahapack, and this is our Power Pack batches. Our Power Pack batches are out and they have started already. What you can do is, if you're looking forward to it, then use the code Y541 and apply it, and you will get it for 2999.80. At this point of time, the Power Pack batches have already started even, right? So if you're preparing for it, we are covering all the topics from the point of view of revision portion. So if you haven't started with your revision yet and finding out the way through which you can do it, then kindly check it out on our website, on our app. This not only covers the revision classes, but will also include test series as well as 150 ebooks as well as 243 recorded videos as well. That means with the current class, you can definitely watch the detailed classes of the same as well. So kindly check it out on our website or in our app, and don't forget to use the code Y541 to get 81% discount if you are using the app. Then 1% is also there. That means you can get it for 81%. So hurry up, check it out now. Tomorrow I'll be meeting you at the same time at 9:30 a.m. So kindly be there at 9:30. Thank you. Bye bye everyone. And if you find this session useful for you, then you can find the PDF of the same in my Telegram channel. The Telegram channel is CAIIB Exam 2023 Niharika ma'am. Right? So this is where you can find the particular details. Kindly check it out on my Telegram account, and you will find the PDF of this particular class there. So thank you everyone. Bye bye, and we'll be meeting tomorrow at 9:30. Thank you.